Trading update with me, Patrick Munley. Want to update the S&P 500 view using the Emini futures contract and put together a trade plan for the trading week ahead, looking at some high probability action areas and some realistic price objectives to play for this week. So, obviously, Friday saw a pretty big dent in the markets after Trump's tweet regarding China trade tariff tensions once again being escalated, and the S&P 500 finished down basically 2.4% for the week after making new all-time highs. Information technology and utilities also made new all-time highs for the week whilst closing down. But most of the damage to the S&P 500 and the sectors occurred on Friday, where the S&P shed 2.9% on the session. Friday's decline almost put the entire range for the month in play. We actually closed below the end of month straddle, 66.02 was the downside level there that we are tracking. And we also have 64.87, which is the monthly options expiration straddle. So we have monthly OPEX this Friday. So keep an eye on that 64.87 on the downside. For the month, then the S&P is now down 2%, and year to date is up 11.4 off the April lows. We are still trading 36% higher, just to give some perspective. Obviously, Friday's close in terms of the weekly candle was a key bearish reversal pattern. And in terms of our time framing, we went from one time framing higher on Friday to one time framing lower. That will be neutralized on a close of 68.06. In terms of the weekly market condition, we're in balance now, 6,500 on the downside, 68.09 on the upside. And monthly one time framing is still higher, with 63.71 being the invalidation point there. In terms of the S&P Gamma flip zone, is now around 6,700, with the Gamma peak sitting near 67.80. Since we're now in negative Gamma territory, so we're roughly 150 to 200 points away from being in positive territory, we can now expect increased volatility, as market makers and dealers likely have to sell into dips and buy during rallies. So that enhances the volatility that we're likely to see as we head into this week. In terms of the calendar for the week ahead, we obviously still have the government shutdown still in play, and so the data slate is going to be adjusted because there will be no CPI, PPI, or retail sales or industrial production releases will also be delayed. They would have been due this week. This really leaves us with a speech from Powell on Tuesday, and the start of the earnings season also on Tuesday, with banks starting to report Tuesday and JP Morgan notable there. And obviously we do remain at the risk of tariff headlines out of Trump, although he has struck a more conciliatory tone over the weekend, which has seen us gap higher, or potentially gap higher here into the open. In terms of under the hood, the market breadth, so S&P stocks trading over their 20-day moving average, 28% versus 59% last week, and over their 50-day moving average, we're down to 36 again versus 59% the week prior, and those trading over their 200-day is now down to 54 versus 65%. So most of the damage there was done on Friday. 200-day is still over that 50% mark. So whilst the tone set on Friday was certainly bearish, until we start to see prints of stocks trading below their 200-day moving average, the general market structure remains supported. We also got a significant bump in terms of volatility, and we've reset a bit lower this morning coming into the session. We're at 20.26. We actually traded above 22 on Friday in a spike move. So we'll see how things fare there. In terms of the volatility level to keep an eye on now is 18.5. Whilst we remain above that level, you can expect some nasty moves in terms of intraday volatility. So keep that in mind. In terms of position sizing, and certainly with respect to stops as well, I would consider sizing down at the moment and allowing positions to breathe a little bit more, so giving yourself a little bit more room on the stop size, but keeping the position size a little lower would be my suggestion heading into this week. We have a public holiday in the States, so it's a slightly weird one in terms of the fact that the payment system or institutional payment system will be offline today. So keep that in mind, because we will have, or in all likelihood, there will have been significant or potentially significant margin calls on Friday. They won't get actually settled now until Tuesday, when the US comes back online again. So keep that in mind. So again, today certainly we can see some volatility intraday at least. So heading to the technical picture, in terms of where we are from volume weighted average price, that closed last week flipped negative on the weekly. So 66.92 is the level to keep an eye on to the upside. As long as we continue to trade below there, the weekly momentum is bearish. Daily momentum is also bearish. Watch 67.05 on the upside. I'll say that heading into today's session, I'm going to use 67.05, 67.15 as my daily bull bear zone. I'll discuss that more when we look at the intraday charts, but keep that level in mind. We did trade on Friday 3 standard deviations to the downside, so that's 65. 30s, 65.40 got tested. You can see there 3 standard deviations, and we did find certainly profit taking, if not buyers, at that level, which is to be expected. So, in terms of the technical setup coming into this week and the action areas that I'm looking out for, or certainly areas where I think we can find decent swing trading opportunities. Obviously, I update the daily levels on a daily basis, and those give intraday and daily time frame. But in terms of the weekly time frame, some key areas I'm going to pay attention to, like I say, 67.15 to 67.20 area. Keep an eye on that today. I think we could see some resistance coming in there. So if we test that area, bearish reversal patterns there, I think we could see another leg lower, or certainly a retest to the downside. The area I'm going to keep an eye on there is going to be 65.90 to 65.80. Now, from there, I think we could see buyers step back in again, and my weekly bull bear zone is actually going to be 67.50 to 67.60. Certainly, any tests into this area coming in advance of rechecking back below the 6600 area, I would be looking at short opportunities there. And certainly the first area to the downside, I'll be looking at our highs from overnight, so back into the 6700 area would be the first area I'll be looking at in terms of pullbacks. If the narrative or the market dynamics switches meaningfully positive, then we would anticipate this area to act as support, and then we can start thinking about a test of weekly projected range resistance. Now, just an update, I posted this morning 66.93, that was a typo. The weekly projected range resistance to the upside is 67.93. Again, any moves into that area I will be using as potential resistance, watching for bearish reversal patterns to get a retest of my bull bear zone from above if that plays out. The alternative scenario is that we find resistance at the bull bear zone, and we look then for a move down into to recheck below the 6600 level. Another level I want to keep in mind, this is an anchored weighted volume average price from the April lows, and that comes in at 65.60. Another area, again, if we test into that, I will be looking for bullish reversal patterns to play a tactical trade from the long side. And ultimately on the downside this week, we have 64.11, which is the weekly expected range support. So any moves into that area, again, watch for bullish reversal patterns, and certainly you can play for a bounce. I personally would be looking at a retest of the anchored weighted volume average price from the April lows from below. So there's going to be plenty of scope this week, I think, in terms of volatility, and certainly once markets are back in full swing tomorrow, I think we'll see an uptick. We've got Trump in Israel and Egypt at the moment with the celebrating the hostage releases and potential peace accords, etc. So I think today we can see some volatility, but I think ultimately the structure for the week is going to be we want to key off this 67.50, 67.60 or up to the 67.93 range resistance. We have this 65.90, 65.80 area also is key, and then below there we manage all risk. Until next time, thanks very much.